The beautiful thing about offset home loans is how they can help you save interest, utilizing any credit balances you've got lying around, and even credit balances of parents' bank accounts. Okay, so I'm going to get into a little bit about how they work and how they're a little bit different to revolving credits. So yeah, let's get started. Offset home loans. Now, let's say you have a home loan and you owe an amount here, and you're paying interest on this figure, right? With an offset home loan, there is a way, and not all banks do them, some banks do, some banks don't, there's a way you can actually utilize credit balances in other bank accounts. What a lot of people are not aware of at times is that you can actually also use parents' bank accounts. The way it works is effectively every night the computer would check the balances of all the linked accounts in your home loan and only charge you the interest on the difference. So basically, in this situation, on this component down here. Now, it does mean that the way it works with parents' bank accounts is that you will not have visibility on your parents' transactions. You will have some visibility on the balance with some banks, right? The parents still have full control over their bank account. They will not receive any interest on that, so it can't be an interest-bearing savings account, for example. And yeah, they just have a normal account with all the rights and use of it like a normal bank account. So yeah, I mean, look, it can help you save a lot of interest. Couple of other key differences. Obviously, the offset home loan runs on floating interest rates, right? Which again means that we have to make sure that we place the right amount on here so that you're not paying interest on a whole bunch of balances that you may never offset. Okay, because especially during times when the floating rate is a lot higher than the fixed rates. The other key difference is how the repayments work on offset home loans, right? So let's say, and this is a key difference between an offset home loan and revolving credits. So let's say your repayment here is a mixture of principal and interest, and let's say in this example, your repayment was $1,000 per month, right? And when it started off, you didn't have all these credit balances. The component of this would be considered to be mainly going towards interest, and a small part would be paying off the principal, right? But let's say you did manage to get some more credit balances, and this grew, and you're almost offsetting most of it. At this point in time, you would still find that the repayments stay the same. So it would still force out repayments at $1,000 per month. It would just be that when you break down that repayment, that most of it now would be principal and only a tiny amount of interest. Unless, of course, you're offsetting the whole amount, in which case the whole $1,000 would be paying off the principal. That's quite different to revolving credits, where you're only really paying the interest generally. And potentially some minimum loss of limit if it's a reducing revolving credit. Hopefully that has made some sense to you. There's still a great way to operate accounts, because you can keep them in separate tranches, which is a bit different to revolving credits. So you could keep a holiday savings going. You could have an account that's under your parents' name. You can also incidentally offset accounts under your kids' names, so you could have multiple transaction accounts. Now, it does have to be at the same bank, but yeah, again, great way to save interest. Talk to us or your financial advisor if you're interested in this kind of thing, and thank you for watching.